All right, this is Ubaid on behalf of Electronics, and in this video, we're going to be talking about competition between markets and intermediaries. Okay, so we've talked about financial market in the past. Okay, this has to do with buying and selling. And we talked about intermediaries. So we talked about wholesalers, retailers, distributors, manufacturers, so on and so forth. Okay, people, who link the supplier and the customer. Okay, these are intermediaries. Okay, in the financial world. Now, when it comes to competition, obviously we don't live, we don't live in a world that is a monopoly. Okay, we don't have monopolies everywhere. We do have monopolies. However, we don't have monopolies, as many monopolies as competitors. Okay, and we're talking about perfect competition here. Okay, where businesses, they compete for the market share. Okay, now when it comes to competition, your suppliers are usually looking for a less risky investment when it comes to lending money. Okay, since we're talking about the financial market over here, we're not talking about the consumer market where you're buying and selling goods. We're talking about lending money. And when you lend money, you want to lend money to a less risky source. Okay, if the source or the person, individual, or business that you're lending money to is very risky, and it's highly probable that you might not get your money back, okay, then this is something that the lender would stay away from in general. Okay, so risk is number one factor when it comes to competition. So number one is risk. Okay, number two has to do with rate of return. Okay, so return. And we're all familiar with this word because we use this when it comes to stock investments. Okay, when you look at the fact sheet for your stocks, you look at the rate of return on your investment. Okay, if you deposit $1,000, what do you get at the end of the year? Okay, that's your rate of return. Okay, how much do you get back? Okay, for the principal that you deposit. All right, and this is what the lenders in the financial world look at as well. Okay, how much do they receive when they deposit $1,000, for example? Okay, and the third one, has to do with liquidity. And we've talked about liquidity back in the past. This has to do with cash flow. So obviously, when you're starting off as a small business or as an entrepreneur, you will need a lot of cash flow. For your operating expenses, for unexpected or emergency expenses, to buy equipment, machinery, capital, land, capital assets, building, so on and so forth, to buy inventory, to invest in inventory, to have money aside for any emergencies, such as spoiled inventory if you're talking about food, such as theft if you're talking about electronics or vehicles, such as other types of shortcomings. So that's the reason why you need cash flow going into the business, and the more cash flow you have, the safer you are when it comes to bankruptcy. Because if you don't have cash flow and you have to sell off your assets, whichever capital assets you might have invested in, it's possible that you may not receive the price that you paid for those assets. As a result of which you're now in loss. Not to mention you don't have those assets, to operate your business. So this has to do with liquidity or cash flow. Now, when it comes to borrowers of money in the financial world, we're usually talking about people who borrow money, at the lowest cost. Because obviously when you go to the bank and request a car loan or request a mortgage, what you're looking at is the interest rate. How much you're going to pay on top of your principal at the end of the month. The lower that interest rate, the more suitable the loan for you. The more attractive the loan. So as a result of which, when it comes to borrowers, unlike the lenders, Lenders obviously want to sell something at a higher interest rate. They want to sell a loan. They want to lend money at a higher interest rate. On the other side, borrowers, they want to look for low interest rate. Okay, so this is low interest rate. All right, and flexible repayment terms. Okay, so this is another one. This has to do with flexible repayment terms. Okay, so whenever you make a transaction, okay, you might have something called repayment terms on your invoice. Okay, when it comes to buying and selling goods. Okay, the same goes for lending and borrowing money. Okay, so when it comes to lending and borrowing money, okay, let's say for example, this is mortgage. Okay, the repayment term, okay, could be 10 years, it could be 20 years, it could be 30 years. Now, the shorter the repayment term, obviously you're going to end up paying more because the lender wants more money within a short period of time. Okay, the longer the repayment term, okay, the less you might have to pay, depending on the interest rates. Okay, and depending on whether those interest rates are fixed or variable. Okay, because you might have variable interest rates where the interest rates may go up, as a result of which you may end up paying more over a longer period of time. Or you may have fixed interest rates where, okay, the total amount of money that you're going to repay is spread out, okay, over, let's say 10, 20, 30 years. Okay, the longer the term, the less you have to pay if it's fixed interest rate. Okay, so this has to do with, okay, flexible repayment terms. Okay, and that would be it for this video when it comes to competition between, okay, intermediaries and the markets, when it comes to competition between lenders, when it comes to lending money, okay, and when it comes to the market share that they compete for. Okay, so that would be it for this video. On behalf of V Electronics, this is Ubaid. Have yourself a great day.